Well, we're on 5:30, so I'm gonna get rolling. Hello, welcome to AngelNV, and we're growing a vibrant startup community here in Nevada. And tonight we're going to be talking about term sheet terms and the terminology that is used around early stage startup investment deals. It can be a little geeky. The math can get a little intense. I'm going to try to use really simple examples, and I probably won't get to all of the topics that I want to cover. So I'm gonna aim for 35 minutes. We might stretch it to 40, and then we'll stop and open it up for questions. If you do have questions along the way, just throw them in the chat. Maggie is going to be monitoring the chat and wrangling questions. And if she thinks it's a question I should answer before we move on, she'll interrupt, and I'll just answer the question on the spot. If she thinks it's something that can wait, we'll wait to the end and answer questions then. So again, thanks everybody for coming out tonight. I'm gonna start my screen share and start present. Okay, according to all of my widgets here on Zoom, I am now sharing. So thanks again, everybody, for coming out tonight. Spend some time with us on angel investing terms and terminologies. First, covering some basics. What is AngelNV and what are the boot camps that we're running? We have a version of AngelNV for founders and startups. This is going to be the final class in that sequence that started back in September. And what happens after this is we run a $200,000 seed investment with the angels that we're training in the other half of this boot camp. The applications are open right now at the link that you see on your screen. You have to apply by February 7th, which is this Sunday. So if you do intend to apply, make sure you get to it by this Sunday. Just get your application in. You will have about a week and a half to tune it and tweak it and make sure it's in the best possible shape for the angels to look at. Application window shuts off after February 7th, so make sure you get it in by then. You will get asked for a $29 donation when you finish the application, but you can work on it and tweak it and decide whether or not you actually want to submit it before you're asked for the money. So if you ultimately decide you don't want to submit it, you never get asked for the money. The way that the contest will work is that we'll take the number of companies that submit their applications. We train the angels. The very first thing they do after we give them some training is they take the number of companies from wherever they are down to 12 semifinalists. Those 12 semifinalists pitch. Then the angels cut the group down to 6. Those 6 companies all go through due diligence over the course of about 6 weeks with all of the angels. And then out of those 6, one company will win the $200,000 investment. In other regions where the same boot camp is run, many times the angels pick more than one company to invest in, although we can't guarantee that, so we don't promise it. But at least one company will get the $200,000 investment, and we're hoping that at least 2 or 3 companies might get investment. Maybe not everyone will get $200,000, but more than one company will get investment. From an investor perspective, we take a group of 40 accredited investors, and over the course of 10 weeks, we train them how to be angel investors. We teach them a lot of the same terms and terminology that we're going to talk about tonight. We spend a little bit more time on it in the course, and the courses are offered in person and by Zoom. To participate as an investor, each investor puts $5,000 into the fund and a $1,000 donation to StartUpNV for putting on the class. The course runs from February 29th through May 6th. May 6th is the final event. That's the event at which the final company will be chosen to get the investment. And the investment usually takes place within a couple of days of May 6th, because all of the due diligence will have been done before then. And if you are curious about how to learning how to become an angel investor, you see the link there on the screen to find out more about it and register for the boot camp. This is our schedule. Like I said, we started the boot camp back in September, and we are continuing to run it through this first week in September while the application window is open. And the investor boot camp starts in a couple of weeks and ends on May 6th. Now we're going to start on the terms and the terminology. So hopefully I won't be putting you all to sleep because this can get a little geeky. The terms that you'll see that we use for investing are divided into two categories, economic terms and control terms. Everything we're going to talk about falls into one of those two categories. From an economic terms perspective, they always deal with the valuation of the company, the treatment at exit for the investors, and then what happens to the founders over the course of the investment. Control terms, pretty straightforward. That means who gets to make decisions, who votes on what, and what kinds of decisions get made. The two most common ways that investments are done are either with preferred stock, which is by far the most common way, or a convertible note. Safes have become more popular. They still tend to be a Silicon Valley only kind of thing. We're not going to be spending any time on them. Safes are a lot like convertible notes, but they just don't have the legal history and the weight of law behind them that convertible notes do. So a preferred stock is sometimes you'll hear people call this a priced round. It is you actually buy a percentage of the company. You hear a lot of the language about this. You'll hear it on Shark Tank. We're raising $100,000 for 10% of our company. So that's a priced round. This preferred stock that you're getting as an investor is senior to the common stock that's out there, and it has certain rights and preferences that go with it, hence the name preferred, that common shareholders and other people that are participating don't have. The only thing it's not senior to is any debt that's been raised by the company. So the loans have to be paid first, then the preferred shareholders are paid, then the common shareholders are paid. That's the order of payment. The convertible note is used when you can't determine a value for the company. When it was originally envisioned or it came into creation, it was done when the founder knew that they were going to raise a round in 6 months or 12 months, but it was just going to take some time to put it together. But they needed to have money now to continue to operate the company. So every once in a while, you'll hear a convertible note called a bridge or a bridge loan or a convertible debt. They all mean the same thing. And what happens is it's short-term debt. In the old school days, it used to be 6 or 9 months. Now it's more common to have these things be 2 years in length. And it converts into equity when a priced round is raised. So if you have a really early stage company that it's hard to determine a value for, a lot of times the investor will just write a convertible note for $100,000. And they won't try to say that it's worth 10%. We don't know. We don't know that the company's worth $1 million or $100,000 or $500,000. So what we're agreeing to is that that decision about how much it converts into is going to be deferred until a priced round is raised. And then when that priced round is raised, the convertible note is converted into preferred stock at whatever the terms are that are negotiated by that investor who has agreed to a priced round. So the convertible notes and preferred stocks often work together, and the convertible note is used as sort of a bridge until you can get to a priced round. So we're going to talk a little bit about convertible notes first, and then we're going to get into some of the preferred stock terms and what they all mean. It's a short-term debt. It converts into equity when a preferred or a priced round is raised. On a convertible note, there'll always be an amount, right? How much is the note for? Is it $25,000, $50,000, $100,000, whatever it is? The term, even though they started out usually being 6 to 9 months, it's pretty common now that a convertible note is between 18 and 24 months. It's giving the founder enough time to go out and raise a priced round. There's an interest rate associated with the note. Most commonly, it's 8 to 10%. I have seen them as high as 18 to 20%, seen them as low as 1 to 2%. Typically, the interest rate is not paid in cash. It just converts to more stock. Although I have seen situations where the note holder has insisted that the interest be paid in cash. That's a little unusual, but it does happen from time to time. The other terms on a convertible note are the discount. Because as a convertible note holder, you're investing at a very early stage when you can't even determine the value of the company, you get a discount. So whenever the priced round is raised, this discount applies. So if you do raise a priced round that values the company at $5 million and you have a 20% discount, that means the convertible note holder buys in as if the company was priced at $4 million because they got a 20% discount. The most common range for the discount is between 10 and 33%. Most commonly, it's 20%. I have seen discounts as high as 80%. That's a bit unusual, but I've seen them as high as 80%. You rarely see them lower than 10%. The next term on the sheet, or the next term on the convertible note, is the valuation cap. This works in conjunction with the discount. It's sort of an either or proposition. So if there's a discount of 20%, the note holder also puts a valuation cap in that says, in no case I'm going to pay more for this company than the valuation that's in the valuation cap. So, if you have a valuation cap of $2 million, even if you raise a priced round that's $5 million, the convertible note holder will buy in as if the company was priced at $2 million, because even though they have a 20% discount, the valuation cap would override the discount, meaning that the most that they would pay for the company was as if it was valued at that valuation cap. The key terms that you want to make sure, whether you're an investor or a founder, that you want to make sure you understand are: how long is this? What's the interest rate? What's the discount that the note holder is getting? And what the valuation cap is. The valuation cap probably is the one that has the most significant effect. But if you have a high valuation cap and a high discount, then the discount may play a more important role in what the valuation eventually is and what percentage of the company your note holder eventually owns. So now we're going to shift over into preferred stock, which is by far the more common way of raising capital, especially if the company is a little bit more mature and you can determine a price for the company and the valuation that your investment is going to have. So we're going to cover some of the economic terms that you see here on the left side of the slide. The ones in blue we will for sure cover. We may not get to all the ones in black, but we'll try to get to all of them. So we've got the economic terms on the left-hand side, and we've got the control terms on the right-hand side, and we've got kind of a slide for each one of these terms. So we're gonna carry on and talk about each one of them. So the cap table, it's a pretty straightforward thing. It's just a table that shows who owns what percentage of the company, what the share distribution is. So all of the raises for the company are recorded in the capitalization table, or the cap table. It tells you how many shares you are authorized, how many shares are outstanding, how many shares are unissued. Everything about the ownership of the company is on the cap table. They usually start out really simple. The founder or founders own 100%. And then you start selling shares, and it can start to get more complicated as the valuation changes and as more and more people and more entities are added to the cap table. There are tools. One I really like is called Carta, and you can track everything in this online tool called Carta. And I think as long as you haven't raised more than $1 million, Carta's free. And once you get over $1 million, then they start charging you for it, but it's still a pretty modest fee. And I like Carta because as you're considering deals as a founder, like, should I do it if I did a deal at this valuation with this kind of a discount? How does that affect the other shareholders? How does that affect things? You can model things in Carta so that you can see what your cap table will look at in different scenarios. In all cases, I don't know a founder who doesn't have a copy of their cap table like within an arm's length reach, because they're always raising money and there's always questions about what's going on with the cap table. So make sure that it's a term you understand, that when you are a founder and starting your company, you keep a cap table very near to your hand so you can chat about it whenever the topics come up. Valuation. This is, you'll hear about a pre-money valuation and a post-money valuation, or you'll hear talk about pre and post. So a super simple concept. What's the company worth before the investment is made, and what's the company worth immediately following the investment? Just to be clear on an example, if you're investing $100,000 for 20% of the company, that would imply a $400,000 pre-money valuation and a $500,000 post-money valuation. But you want to make sure you're clear before you invest or before you take money. Is the company worth $100,000, or is the $100,000 going to make the company worth $500,000, or are you taking 20% of of the valuation for $100,000. It makes a difference. So you want to be clear on your pre and post money valuations before everybody signs papers and before you proceed with your term sheet. So make sure that you understand it. Simple idea, but make sure you understand it before you take money. The option pool. Every founder, every startup generally wants to share stock with their employees and other key helpers that are helping them in the success of their company. So what you do as a founder is you create a stock option pool to award to those people that are helping you. Most of it goes to employees. Usually you are issuing 10% of your stock into the option pool, meaning that if it's entirely issued out, that the people who are in this option pool would own 10% of your company. When you're getting an investment in your company, almost without exception, the investors will make you issue the option pool before their money comes in so that they don't get diluted right away by the option pool being created after they've invested. So if you're an investor, it's a very reasonable thing to ask. If you're a founder, don't argue when somebody asks you to create the option pool before the investment is made. As a matter of fact, your investors might get mad at you if you don't, even if they don't ask. It's the common way to go about doing this. And the reason you want to make sure that you've got it issued at the right time is we're going to look at how the math works. So, if you're investing $100,000 for 20% of a company, implying a $500,000 valuation, there's no pool before the investment, right? So there's 0% in the pool. The founders own the whole company. If you establish the pool before the investment, the pool is 10% because that's what the pool is. And then the founders would take the full dilution of that pool, meaning they only own 70% and the investor would own 20%. So the founders are diluted by the creation of the option pool. If you establish the pool after the investment, the pool would still be 10%. The founders would end up with 72% and the investor would own 18%. So the investor and the founders split the dilution created by the pool. And most investors they won't do it. And it's common to have that pool issued before the investment comes in. And remember, as you set up your pools, you can set up a pool for 10%. If you never issue all 10%, then the stock is never issued. So it remains in the pool, or it never gets issued. So if the company's bought before it's all issued, then that percentage goes back to the founders. Preference. This is the big thing for preferred stock. So it tells you the order and the multiple of the payments when the company is liquidated or it's acquired. The preferred shareholders are paid first, and this is where that's stated in the preference. If there's a multiple, then you have to figure out, you negotiate a multiple with the investor. Most commonly, it's a 1x multiple, meaning that the preferred shareholder gets their money back that they invested before anything else happens. Sometimes they'll say, I want 2 times my money back before anything else happens, before anybody else gets paid. But in almost all cases, they get at least 1x their money back before anybody else gets paid if there's a liquidation or an acquisition of the company. And there's 2 different forms of preference. The most common one is non-participating preference, and the other one is called participating preference. And we're going to cover both of those right now. So non-participating preference is an either-or decision, and it gives the preferred shareholders a choice in how they're going to take their payout. So when the company is purchased, they can either take their multiple and walk away. So if they have a 1x multiple, basically they're getting their money back. If they're getting a 2x multiple, they're getting 2 times their money back. And that's before anybody else gets paid. Or they can convert their preferred shares into common shares and sell them at whatever the rate is that was negotiated for the buyout. And it's an either-or situation. Typically, if the buyout or the liquidation is for a low amount of money, then the multiple, then taking your liquidation preference with the multiple is the better way to go as an investor. If the company if you hit a home run, the company's rocking and it gets a really high sale value, then it's way better to convert to the common and share that and sell your percentage of the company at the negotiated price. So as an example, we have An investor who's invested with a non-participating preference, they invested $100,000 for 20%. If the acquisition is for $200,000, not great. If you thought that the company was worth $500,000, they would take their liquidation preference, meaning that they get paid their $100,000 before anybody else get paid. Otherwise, they would only get 20% of the $200,000 because they own 20% of the company. They'd only get 40 grand. So in this case, they would say, I'm going to take my liquidation preference for $100,000, leaving $100,000 for the founders and anybody else that needs to be paid. So low sale value, you take the liquidation preference. If the acquisition price was at $500,000, they wouldn't care because it's the same either way, right? 20% of $500,000, they get $100,000 back, or they can take their liquidation preference, they get $100,000 back. Still not a great deal for the investor because they're just getting their money back. They're not actually making any money. Now, when you get up to $1 million, they have the choice of taking 20% of $1 million or $200,000 or their liquidation preference. Clearly, they're going to take the 20% of $1 million. And if the acquisition price is for more than $1 million in this example, as the money goes up, it's always better to convert and take your conversion and sell your stock at the negotiated price for the company. So that's non-participating preference, by far the most common way of preferred stock to be done, whether it's in pre-seed round, an angel round, or even an A and a B round. Every once in a while, you get into some other folks that will do participating preference, which we're going to cover in a minute, but that's much less common. Probably in fewer than 5% of all deals out there do we end up with participating preference. Non-participating preference is 95% or more of all the deals that are out there. Participating preference allows the investor to double dip. So they get to take their preference and they get to keep the percentage of the company that they negotiated. So because they're getting paid first and they're getting their preference, and they're potentially a multiple on their preference, and they're getting to keep their stock and sell that too, it can really leave, especially in low payout situations, it leaves very little money for anybody else that doesn't have this participating preference as part of the deal that they make. You'll often hear this called a vulture term or a sharky term, generally thought to kind of damage all of the investors who came before them because they're making sure that they're getting the multiple and they're taking most of the money that might come in before anybody else gets paid. So if you've got a multiple and participating preference, it can really hurt your other shareholders. So some examples of how this might work. The same example we used before, $100,000 for 20%, and we're going to say that they have a 1x multiple. So for an acquisition of $200,000, they get their $100,000 liquidation preference, plus they take 20% of the 200 that the company was bought for. So they get $120,000 on the deal, and $80,000 is left for everybody else to distribute. So whether it's probably the founders that are left, but it may be some others that didn't get this participating preference that are left to split the 80. Let's just say the acquisition was for $500,000. And remember before in the same example, it didn't matter. Now, in this case, they get their $100,000 liquidation preference, plus they take 20% of the $500,000. So they're getting $200,000, leaving $300,000 to distribute to everybody else. So they're getting 40% of the money, even though they only own 20% of the company, because they've got this participating sort of double dip preference. So that's, kind of sharky. And if the acquisition price is at $1 million, again, they're taking their $100,000 liquidation preference plus 20% of the million. So they're taking a $300,000 out of the company. In other words, they're getting 30% of the money for the company, or they're getting paid as if they own 30% when they only own 20% because of this participating preference term that they had negotiated. So as founders, when you see participating preference, your antenna should go up. There are some situations where it's really the only way you can make a deal as a founder, but just you should understand what you're getting into with this term.
Hey, Jeff.
And yes.
So 20% of 200,000 would be 40,000.
Okay, I've done my math wrong. So it's 140,000 with 60K left to everybody else. So I'll have to change my slide. Thank you for catching that. So again, this is just something as a founder you want to watch for. And if you're not really expecting it and it comes up, it puts my antenna up for, who are these folks that I'm making a deal with? Is this kind of what I expected? Am I in a situation that this is being offered because they kind of think maybe I'm a little bit desperate, and this is the only way I can make a deal is by offering these kinds of terms. So, and like I said, in some instances, it's the only way you can make a deal. When the numbers get really large, I mean, if you just kill it, like if this $1 million acquisition turned into a $200 million acquisition, well, the impact is much, much smaller at that point. So because the liquidation preference gets kind of washed out in the percentage, and it just doesn't have as big an impact when the numbers are really big. And that's usually how it's sold by the investors. It's like, well, you're going to kill it, right? You're going to crush this. This is going to be a unicorn. So it shouldn't really matter if I've got participating preference, because the little extra that I'm getting as a percentage doesn't make that big a difference. And that's usually how it's sold. Aren't you confident, Ms. Founder, that you're going to just kill it? You should be willing to take that risk. So, but again, antenna should go up when you see this term come in there. Dilution is always something that's dealt with in the preferred round. It's going to be one of two kinds of dilution. It's either going to be weighted average or full ratchet. There occasionally will come up with some hybrid between the two of them, but most of the time it's one of these two. Weighted average, and the time that dilution comes into play is when you have a down round. In other words, you've raised the round with a valuation of $1 million, on day one, and then you get into day 180 and things aren't going well. You still need to raise more money. The company's not worth $1 million anymore. The best you can do is raise at a valuation less than that, and now people are going to get diluted. The question is, how is it going to work? Weighted average dilution, anti-dilution, shares the pain of the dilution in a down round between the investors and the founders. So both the founders and the original investors take a little bit of the pain of the down round. They share it. So there's a formula on the left-hand side of the slide. I'm not going to bother to go through it with you. You can write it down or put it in your spreadsheet and run it on your own. But a couple of quick examples that I think will make sense. Although when we're talking about these numbers on slides, I know you can get lost in the math on this sometimes. So if the investor invested $400,000 for 40% with making $1 million valuation, the next investor offers $500,000 for 50%. If there's no protection at all, you end up with, as an investor, owning 20% and the founder owns 30% and the new investor owns 50% because that's what they negotiated. So that's if you have no definition for what happens in a down round. If you use a weighted average scenario, the new investor still owns 50% because that's what they negotiated. And you as an investor end up owning about 25% and the founder ends up owning about 25%. Depending on the exact calculation, that can vary a little bit, but you're going to be usually within 1% of that type of a scenario, and the one that I just laid out for you. So the original investors do end up sharing some of the pain of a down round, but not all of the pain of a down round if you've got weighted average anti-dilution. Full ratchet anti-dilution, what that does, if you're an investor, that means you're fully protected. If there's a down round in the future, your investment is repriced at the same rate as the down round, and you are completely protected from being diluted because of that. But who bears the dilution? Well, the founders do. So if you're a founder and you see full ratchet anti-dilution, again, that's one of those things where your antenna should go up. It's like, well, who am I doing business with here? And and again, it's sold on the basis of, well, we're not going to have a down round. Why are you worried about this? This thing's going to the moon. This is a rocket ship. Why would you worry about that? But this is one of the ways. I mean, if you combine full ratchet with preference, participating preference, this is when you hear founders getting wiped out. It's usually a combination of those two things that wipe out the founders, because under The scenario we just talked about before, where the investors invested $400,000 for 40%, a $1 million valuation. The next investor offers $500,000 for 50%. Under full ratchet, the original investor still owns their 40. The next investor owns their 50, which leaves the founder with 10. And it can get pretty brutal with full ratchet dilution for the founders. So if you're a founder and you hear or you see the full ratchet anti-dilution in your term sheet or in your deal, usually it's a sign that either someone's trying to pull one over on you, or that the founder is in a desperate situation and it's the only way that they can get the deal done. So there are times when it's the only way you can get a deal done, but it's a risky prospect for the founder. I'm going to skip ahead to some of the control terms, or I'm going to go quickly through some of these so that we can get to some of the control terms and then leave some time for questions. Pay to play is really is if you expect you're going to continue to raise money from the same set of investors. It forces the investors to pay to keep their preferred rights. So if you raise a $100,000 round and now you're raising another $350,000 and you've got pay to play, if the investors don't participate in that next round, then they lose all their preferred shared rights. You usually don't see this in angel and early stage investing. It's very common to see this in A rounds and beyond. So it can really put the founders and the investors at odds with each other when the founders are forcing the investors to pay to play, because they can bounce them out of the preferred status by just saying investor get out. So it's a bit of a sharky term on the investor side to force a pay to play. Prorata rights is something that most investors want. They don't always take them, but it's the idea that as you raise another round as a founder, that the early investors get to pay up to keep their percentage. Now they have to pay at the new rate, but they have the right to do that. A lot of times in later rounds, A rounds and B rounds, they want to essentially squash the pro rata rights of the earlier investors, and will oftentimes do pretty sharky things to make that happen. But the folks that are pretty honorable, they might say, hey, don't take you may have pro rata rights to take a full 20% because that's what you bought, but that doesn't leave enough for all of the rest of us who are buying in at a higher rate, so take less money. Pro rata rights is something as an investor you always want to have, but you don't always exercise it. So, but if you do have those rights, you do have to be ready to pay if the company's raises another round at a higher price. You have to have the money to actually buy in at that higher price. So if you do like that as an investor, make sure you have enough dry powder to be able to actually exercise on your pro rata rights. If you've got a company that's really hot, you want to buy as much of it as you can, and having those pro rata rights as an investor are an important thing to have. From a founder perspective, it's not really a good or a bad thing. Sometimes you have to be a referee between the round that you're raising now and your prior rounds for the people that have the pro rata rights, but it doesn't really affect the founder one way or another. Now we're going to get into control terms. So the most common control term is board seats. Usually you don't get this as a pre-seed or a seed investor. Sometimes seed investors get board seats. Usually the board seats start to come in at the A round. And the board gets to make all sorts of strategic decisions, from what the pay is of the CEO and the founder and the officers in the company. There are certain purchases and numbers that the officers in the company can't go above without getting board approval. Anything that has to do with mergers, acquisitions, stock rights, all that stuff, the board are actually making the decision about those kinds of things. And the founder or the founders of the company are a participant in the board, but they aren't the sole decision maker, like they were when they were the founder and they didn't have a board. So the way the boards are usually divided up are this 40-40-10 rule, where the founders make up 40% of the board or assign 40% of the seats. The investors assign 40, and then they agree on the other 10. They bring in an outsider to represent the other 10. And usually the outsider is some sort of expert in whatever field that the business is doing business in. So it's pretty common to have this, 2-2-1 kind of makeup, a 5-member board, where the 2 are the founders, 2 are the investors, and 1 is an outside person. Significant investment is required to get a board seat. Usually, somebody with a board seat is buying in at least 15-20% of the company. Sometimes the requirements are even higher. And they meet every quarter or as needed to make decisions depending on what's in the purview of the board. A drag along right. This is important when it comes time to be acquired, because you hear these stories, or you see it in movies where the lone minority shareholder is forcing them to not sell the company, and that just doesn't happen, because almost everybody has the drag along right, which means that if you get a good offer for the company, the majority of the shareholders can force the sale, and the minority folks just have to go along. They get paid same as the majority do, but they don't get the right to undo the deal or be the squeaky wheel or try to negotiate a better deal for themselves. So a drag along right as a founder and as a majority owner is important, because you don't want folks that aren't all the way bought in to be able to kill your acquisition going down. Protective provisions. There are things where the preferred shareholders can veto a decision, rather than, they can't necessarily make a positive decision on something, but they can veto a decision. Usually it's around authorizing different classes or different types of shares, selling a lot of assets for the company, declaring dividends, things like that. The preferred shareholders with protective divisions can veto. They can say, nope, not doing it. It gives the shareholders who aren't on the board a way to have at least a veto vote on some of the big things that might not be in their interest. So it is a little bit of a special protection for those folks who don't have the drag along rights and the board seats. Some other things that are important to have: information rights as a founder, or as an investor. You always want to make sure that you're getting your periodic reporting. And as a founder, you want to give your shareholders periodic reporting. Quarterly is usually enough for everybody. You don't need to do it every month. Voting rights comes along with the share of the type of shares that you own and the percentage that you own. First right of refusal is exactly what it says. As you have stock pools and other shareholders, as your company goes on, while you're still private, sometimes they'll want to sell their shares to people you don't even know. It's like, well, I need some money to buy a house, and I've got these preferred shares, which I can't just sell. But I found a buyer who wants to buy them from me. Well, you as a preferred shareholder and as a founder, you can either stop them from selling it if you don't like the person that they're selling it to, or you don't like the price that they're selling it at, or you have the right to buy it back. That's what the first right of refusal means, that that the people that have preferred shares just can't sell them to anybody whenever they want. They actually have to get permission before they do that. Even though they own that asset, they don't own it without exception. And then I think the last thing to talk about is a lockup. Is if you do get to the situation where you do take your company public, don't think that, woohoo, it's time to celebrate, I'm going to sell a bunch of my shares as the founder. The founders and the insiders are locked up for 6 months. You can't sell your shares. So even though you own them and the company is now public, there's a whole bunch of legal qualifications that you have to go through with the SEC in order to sell your shares as an insider. And it can get a little tricky, but just know that the general rule is you can't sell for 180 days. All of this stuff is pretty geeky and pretty detailed. If you really like it, I went through it pretty fast. So if you're a founder or a venture capitalist or a prospective angel, I would recommend that you get this book, Venture Deals by Brad Feld. Brad goes through a lot of examples in his book, much more slowly than I did in this presentation, and written down in a way that's a little easier to understand. This is not a 101 version, though. I mean, this is probably more like a 201 or a 301 kind of class in the book Venture Deals. But you can take your time and read through it. Whether you're a founder or a potential investor, these are topics that you definitely want to know. So take the time to sort of absorb the presentation here tonight. We'll have it recorded and available on the YouTube channel within a couple of days. And then for more follow-on reading, check out Venture Deals. That's the end of the presentation.